Hello everyone, my name is Adam Livingston. I am the Bitcoin Wizard broadcasting for Firefish, the world's greatest Bitcoin-backed lending marketplace. Today we're going to be talking about why Bitcoin is going to demonetize real estate, and it is inevitable. So let's start with the simplest way to understand this entire thesis, because the housing market has been running a psychological scam on your nervous system for over 40 years. Real estate, at the end of the day, really has two parts. The first part of real estate is the shelter utility. You live there, you sleep there, you hide from your boss's emails there, you store your emotional support air fryer there. Second part is the monetary premium. This is the part that nobody likes to admit out loud, especially your real estate investor friends out there. This is the extra price that people pay because they are terrified of money turning into compost. They buy a house the same way that medieval peasants bought silver, as a defense mechanism. And for decades, society's default savings plan has been buy the biggest wooden box that you can qualify for, strap it to a 30-year debt chain, and pray that the Federal Reserve continues to print so you somehow look like a genius. That has basically been the religion that we've been indoctrinated with. Make sure that you are investing in your home because that's the only way that you can stay not poor. Now enter Bitcoin. What is Bitcoin? Well, it's obviously the world's greatest savings asset with instant liquidity, portability, and a verification system that doesn't require you to beg a bank teller like a Dickens orphan for access to your own capital. It trades 24/7. It doesn't leak. It doesn't get termites. It doesn't call you at 2 o'clock in the morning because the water heater started screaming. So what happens when a superior savings technology becomes available to the masses? The monetary premium just begins to migrate, and this is the demonetization process. Because yeah, people will still want housing. You can't live in a Bitcoin after all. People still want their nice neighborhoods. People still want a place to live. They just stop needing a house as a personal piggy bank, an inflation bunker, and a retirement plan duct taped together with Home Depot receipts and emotional denial. Now, Bitcoin bears completely miss this because their entire worldview is built on trauma and cope. They stare at a chart like it's a horror movie and they scream that it's going to zero, while they're holding dollars that get quietly shaved every single year, like it's a slow motion robbery where the thief sends you a thank you note. And the real comedy is that society has just trained us all to think the responsible thing is to pour your life savings into a single illiquid asset in one jurisdiction with one set of laws, one tax assessor, one roof, one foundation, one neighborhood, one local government that wakes up every morning thinking, how do we extract more money from people who can't move? And Bitcoin sits there like a black hole for all of that real estate monetary premium. It is going to absorb the function of store of value with zero maintenance and zero bureaucracy, and suddenly the housing market is going to lose its bonus feature, the feature that made people bid on houses like feral animals. And that's why this presentation exists today, because I want to tell you about this two components model. You will realize that the real estate market has been inflated by monetary panic for years, and Bitcoin turns that panic into choice. All right, now we take the mask off of the housing market, and yes, it's very unsettling because underneath is a giant credit machine wearing a cozy sweater that says American Dream. The monetary premium is the part of housing that exists because people are trying to store value inside something physical, local, and politically protected as well. Because remember, fiat money has spent the last century slowly turning everybody in society into a reluctant speculator. People wanted a savings account. Instead, they got a casino with a roof. And you can see this in the way that housing stopped behaving like a normal consumer good. Normal goods get cheaper when productivity improves. TVs got better and cheaper. A lot of technology did. Basically, the things that they use to continue to enslave you always get cheaper. And the things that require you to not be docile tax cattle, well, those always get more expensive. And at the same time, the wooden rectangle with drywall, 2 bathrooms, and a garage went from nice to congratulations, you're now indentured to a spreadsheet. That's because the price wasn't driven only by shelter demand. The price absorbed financial demand. Housing became a vault. Housing became collateral. housing became a store of value with a front door. And this is where society just totally lost the plot. Instead of building an economy where saving in money made sense, we created an economy where saving in money just felt like self-harm, so everyone stampeded into something that was perceived to be scarce, like stocks, real estate, collectibles, watches, art, you name it. You see, people buy assets the way that they buy bottled water in a hurricane, and then they pretend that it's a rational portfolio decision. And then you zoom out and just look at the machine behind this thing, the disgusting bureaucracy, the housing financialization, the mortgage securitization, the credit expansion, government policy, banking incentives. The whole system learned that if you get a population to treat homes like a primary savings vehicle, that means that they're going to work harder, they're going to borrow more, they're going to accept more risk, because the reward is this illusion of wealth that is created by rising nominal prices. So when people brag about their real estate returns, a lot of the time they're just bragging about the monetary regime that they're living in. They're bragging about the fact that the currency units lost purchasing power and credit got easier, and the house was the sponge that soaked all of it up. And the Bitcoin bears, again, they have perfect talent for missing a point. You know, these people, they'll look at a home as an investment and they'll say, see, real assets win. Meanwhile, the real asset required leverage, a broker fee, taxes, insurance, maintenance, municipal bureaucracy, and a personality disorder where you start saying things like, my tenants are great, while you're dead inside. Here's the key. The monetary premium exists because people needed somewhere to put their savings that wasn't melting. Real estate just had to become the default because it was the least bad option that was offered to average people. Can you imagine reality before Bitcoin? Good heavens. Because Bitcoin changes that entire equation. It offers a savings vehicle that's liquid, global, credibly scarce, without being attached to one neighborhood's political mood swings. Now we need to talk about the actual mechanism here, the actual plumbing, the parts that makes people very uncomfortable because it reframes the housing market as a behavioral phenomenon. Picture the marginal home buyer out there, okay? You might be one yourself. You know, the person who sets the price at the edge. The person who's putting the offer in, not the family buying their forever home because they love the schools. The marginal buyer is the one buying because they feel cornered. You know, these people, they feel the clock ticking. They feel the money rotting in their account. They feel like renting means they're falling behind. Yada, yada, yada. You know the deal. They feel like the only way to keep up in this society is to buy a house and ride the escalator. That emotional buyer is the monetary premium in human form. For decades, the script was very simple. You save cash, you get punished, you buy a house, you get rewarded. So the brain learns that pattern with everybody in the populace. It turned into an absolute religion. HGTV became a thing. People started speaking in tongues like they're not making any more land while they were standing in a suburb that used to be cornfields. And Bitcoin rewires that marginal decision that people are making here, because when someone has a credible savings asset in their pockets, well, the psychological hostage situation just tends to end because they can rent and save, they can move for a job, they can live where they want, not where their mortgage chain says that they happen to belong. They can totally opt out of treating shelter like it's a retirement account. And once that becomes common, this is what changes, because first, speculative demand just loses the oxygen, the frantic bidding, the fear-based overpaying that you see when the housing market booms. The date the rate, marry the house, cope slogans, all of that starts sounding like a timeshare presentation or like an MLM thing. Then second, all of the multiple home hoarders, they become harder to justify because the whole vibe of I'm building wealth through acquiring doors, that starts competing with a much cleaner option. Just accumulate a liquid but scarce asset that doesn't require property managers, midnight phone calls, or pretending that you enjoy talking to contractors who just rip you off. And then third, the reflexive feedback loop weakens because when housing stops becoming the default savings engine, that means that fewer people treat price appreciation as 100% guaranteed. That alone changes behavior. The market becomes more like a market and less like a nationwide group delusion sponsored by low interest rates. Housing will keep its utility value, absolutely. Location still matters. The scarcity of desirable areas still matters, of course. People will always want safety, they'll always want space, good schools, and a backyard for the dog. The difference is the premium people pay just to escape fiat decay that will start to migrate into Bitcoin because Bitcoin performs the savings function better than a building that slowly breaks and sends you invoices, so the mechanism is very simple but brutal. When the marginal buyer stops panic buying homes as a savings technology, the market loses the extra bid that made everybody feel like a genius, and society will still build houses. It will just stop worshiping them. All right, now we introduce the thing that turns this from a philosophical argument into a capital markets execution: digital credit. Because Bitcoin doesn't only siphon the monetary premium out of housing, Bitcoin also creates a new kind of financial gravity where companies are obviously starting to buy Bitcoin, then they finance against their Bitcoin stack, and then they issue instruments that give investors very high yield without turning them into part-time plumbers. Now, obviously, Michael Saylor and Strategy have pioneered the template in public markets, a Bitcoin-rich balance sheet that becomes a platform for these instruments. And once you have that platform, that means that you can start issuing preferred securities designed for different investors of different risk tolerances, paying out a variety of different yields. You know, the same way that the credit markets have always done, just with Bitcoin as the core strategic asset because it's the best form of collateral ever. Now you might be asking, Adam, why does this matter for real estate? Well, let me tell you why this matters for real estate. Because real estate investing for most people is a yield fantasy wrapped in a lifestyle tax. Everybody loves the idea of passive income. Nobody loves the reality of passive income. The passive part is the Instagram caption that you make. The income part is you eating a $6,000 repair because the house decided to adopt a new personality. Now, digital credit that is made economically feasible by Bitcoin, it is going to these real estate investors out there, all of the yield junkies in the world, and it's offering this competing value proposition. You buy an instrument, you collect a dividend, you keep your weekends. Strategy's perpetual preferred example, like STRC, also known as Stretch, is the cleanest illustration because this pays a cash dividend, and right now the headline number is 11.25%. It's paid monthly in cash, and all you do is sit on your couch and collect a paycheck, which is more cash flow than you get from real estate, but you don't have to go unclog any toilets. And remember, the rate mechanics make sure that it stays around par, the $100 price. It gives you cash flow, and you don't even have to do anything. And we're only 1 year into digital credit. Look at how credit was issued against gold for hundreds of years. This is the new monetary architecture upon which our society is going to be built. Bitcoin is changing everything, and it's coming for the yield seekers. This number right here makes the average real estate guru start sweating through their linen shirt because suddenly the investor's brain says, wait, I can get income without acquiring a second job called landlord? So let's take a quick breath here and let's be adults for 10 seconds. Obviously, preferred dividends carry risk. We know that companies can face drawdowns, of course. Market conditions change, mechanics change. Nobody gets to print free money forever, okay? So this isn't grandma's savings account, but the competitive threat to real estate is still massive. Because even with risk, the convenience is obviously pretty violent. Think about the risk here. The risk is that Bitcoin just continues to do what Bitcoin always does, which is go up forever, Laura. And at the same time, real estate is asking you to concentrate capital in one property, in one geography, with one set of laws. Then you pretend to enjoy being a micro utility company for strangers. And then digital credit asks you to allocate capital in a liquid market and then outsource the operational nonsense. You think that millions of investors aren't going to internalize this trade-off? The housing market is going to lose another chunk of demand, the demand that came from people chasing yield through property because there weren't many alternatives that felt accessible and simple. But here, all I have to do is click the buy button on my phone. So when I say that Bitcoin demonetizes real estate, I don't mean just Bitcoin, I mean the corporations. They're using Bitcoin to tap the $300 trillion fixed income market. And oh yeah, the real estate market too, because people realize they can get a better yield for less work. What's been the main gripe with Bitcoin? It doesn't yield anything. Yeah, well, guess what? Until now. We know that real estate investing gets marketed as passive income because the industry has to sell the dream. If they described it accurately, the brochure would say, congratulations, you just bought a middle management role inside of a decaying building and your customers are legally protected chaos. The gap between fantasy and reality is where the demonetization is going to accelerate because Bitcoin-era capital alternatives make the hassle feel suddenly insane. Let's walk through the landlord math the way that it actually works. You buy the property, you put down capital, you borrow the rest. So from day one, you are leveraged. Then you collect rent, and the rent looks great on paper until the universe starts sending you invoices. So then what happens? Well, vacancy happens. The tenants rotate. Someone loses their job. Someone's cousin moves in, and now there are 6 people in a 2-bedroom. Someone decides that pets are a human right and brings in a dog the size of a small horse. Then you get a call late at night. The water is leaking, the furnace is dead, the roof is doing performance art. The city sends you a letter written in pure contempt. And then there's property taxes, which operate like a subscription service for existing in a jurisdiction, except the price only goes up and the customer service is a guy who hates you. And then insurance gets repriced because a model in an office decided that your zip code now lives in Mordor. Maintenance just eats the yield, CapEx arrives in waves like punishment, then you refinance and discover that interest rates have models. This is the hidden cost. Real estate yield comes with a required second life. You either pay with your time or you pay a property manager, and the manager charges you money to translate chaos into paperwork. So when someone says real estate is passive, what they mean is I outsourced my suffering and now I pretend that the spreadsheet is the whole story. Compare that with Bitcoin, okay? No tenants, no midnight phone call, no city inspector, no rats, no HVAC priest. Just click a button and buy. In a Bitcoin world, the escape hatch changes shape. If a person can hold Bitcoin as savings and access yields through digital credit instruments, or borrowing against their Bitcoin to invest in digital credit instruments, and borrowing against your Bitcoin on Firefish, which is the best Bitcoin-backed lending marketplace on planet Earth, well, the compensation for hassle has to rise to justify it, doesn't it? And when compensation has to rise, that means that the prices have to stop being insane relative to rents. Cap rates face pressure, investment demand softens. The housing market has been propped up by people chasing financial security through property because they didn't have clean alternatives, and Bitcoin brings the clean alternative. And we know that housing obviously enjoyed a very ridiculous structural tailwind for a very long time, because construction productivity has been very slow, the labor has been constrained. Getting permits is an absolute nightmare, and the whole process behaves like it was designed by a committee of people who hate efficiency. So prices stayed high, and then everyone told themselves that it was destiny. They turned building is hard into a permanent law of nature like gravity, taxes, and your uncle forwarding you market crash videos at Thanksgiving. And now AI and robotics show up and start chewing through that premise. First of all, AI is going to attack the white-collar inefficiency inside of construction. All of the scheduling, the procurement, the design iteration, clash detection, waste reduction, all of the stuff that quietly bleeds time and money. Most projects run over because humans run projects the way that drunk people pack for a trip. They panic, they forget half the items, and then they spend triple at the airport. And then second, robotics will attack the labor bottleneck. Have you seen the 3D printed houses? All the tasks that used to require skilled labor and repetition and time itself, they start getting industrialized by 3D printers and humanoid robots. And this is the key. When you standardize home building with this advancement in technology, that means that you get cost curves And when cost curves get here, that means that you get deflationary pressure in the price of homes. Not on every mansion in Malibu either. I'm talking across the broad middle where most housing exists. People underestimate this because they're trapped in this mental model of construction like it's suffering, like every house in existence is a cathedral that has been built by monks with hammers. Reality, though, is closer to a supply chain, and supply chains get wrecked by automation once the tooling improves. And society is obviously incentivized to push this because governments want more housing, developers want higher margins, buyers want lower costs, everyone wants faster builds. The only group that fears productivity is the group whose entire net worth depends on the existing stock staying scarce and overpriced. And those people already complain about everything, so who cares? This just obviously changes the long-run pricing power of housing as an asset class, and when you combine that with Bitcoin absorbing the monetary premium, you get a very nasty double effect. Houses will lose the store of value demand on the way in. They will get a productivity-driven supply response on the way out. This is why the demonetization thesis really has teeth, because it isn't just one thing, it is multiple forces converging. Bitcoin is going to pull the monetary premium away, and then technology is going to compress the physical cost base. And the housing market starts behaving like shelter again instead of a national collectible. Coin is the future and real estate is the past. This is just more of a bullish reason why you should take a loan out against your Bitcoin. But this is not financial advice, this is financial entertainment. If you could please like this video and subscribe to the Firefish YouTube channel, we would greatly appreciate it. Visit firefish.io to have a look at all of the amazing options for loans against your Bitcoin. Have a terrific day. Do not party too hard. Class dismissed.